Go back to May, a primary round where they're valued at 66 billion. Usually ahead of an IPO, you try and get in because you're excited. But what we're hearing is that private market deals are valuing the company lower.
That's right. Our colleagues in Hong Kong is reporting that the private valuation, these are minority trades, are valuing the company as low as 45 billion. At a point, they were valued at 100 billion. So it's a significant decrease. And I think part of it is probably to do with that the IPO prospect is looking a little bit more dim than it used to. We have seen reports that the company is now subject to regulatory scrutiny not only in China but also in the US. So that could make investor a little bit more jittery about the prospect of this company's public life.
They were going to target up to $90 billion in that IPO. So the fact that they're seeing it half of that in secondary market, albeit before the turn of this year. More broadly, put it in the context of a company that's trying to distance itself from China, but still manufactures in China, its headquarters being in Singapore. But we're very worried about the Chinese economy right now. Is that in any way filtering through? More broadly, tech stocks have been under pressure.
So they actually do not sell in China. They do not generate revenue per se in China. They do manufacture there. They also gather user data from the internet, and that is why the Chinese regulators are now looking at this company. And by looking at economy just globally, you do see some softness in the U.S. and the majority of the revenue they do focus in the U.S. market quite a bit, selling crop top, $5 crop top to teenager, and that's the kind of spending that would soften in a market where inflation could go up and economic prospect is not so bright anymore.